Welcome to our lecture series in financial technical analysis. Today we will talk about Bollinger Bands, a popular technical analysis tool. Let's begin. Bollinger Bands are a popular technical analysis tool created by John Bollinger in the 1980s, specifically designed to measure market volatility and help identify potential overbought or oversold conditions, as well as signal impending breakouts or reversals in asset prices like those seen in SPY daily data. These bands assist traders in spotting overbought conditions when prices approach the upper band and oversold when they near the lower band, while also providing signals for potential breakouts from periods of low volatility or reversals in price trends. At their core, Bollinger Bands consist of three essential lines: the middle band, which is the central reference, the upper band set above it, and the lower band positioned below, all plotted around the price action. The middle band is calculated as a 20-period simple moving average, or SMA, of the typical price, serving as the foundational central reference point for the entire indicator structure. The upper band is derived by adding two standard deviations of the price data to the 20-period SMA, whereas the lower band is formed by subtracting two standard deviations from the same SMA, creating dynamic boundaries. This specific mathematical construction, using the 20-period SMA and two standard deviations, enables the bands to dynamically expand or contract in response to evolving market volatility conditions over time. The vertical distance between the upper and lower bands serves as a direct visual measure of current market volatility, widening during turbulent periods and narrowing in calmer phases. In periods of heightened market volatility, such as during economic news events, the bands widen significantly, much like inflating sails catching stormy winds, accommodating larger price swings. On the other hand, when market volatility decreases, as in consolidation phases, the bands contract and narrow tightly, resembling leather straps cinched around tranquil, calm waters with minimal price fluctuations. A primary interpretation rule is that when the price touches or pierces the upper band, it often signals overbought conditions, increasing the likelihood of a downward reversal or pullback in the near term. In a similar fashion, when the price contacts or drops below the lower band, it typically indicates oversold conditions, suggesting a potential upward reversal or bounce as buying interest emerges. A band contraction, commonly referred to as a Bollinger squeeze, represents a phase of exceptionally low volatility and is a reliable precursor to a significant price breakout in either direction. After observing a squeeze, the subsequent band expansion indicates rising volatility and often confirms the direction of a strong trend continuation as the price breaks out decisively from the tight range. In practice, traders frequently combine Bollinger Bands with complementary indicators such as the relative strength index for momentum and the moving average convergence divergence for trend confirmation. Integrating Bollinger Bands with RSI and MACD allows traders to validate signals more effectively and minimize false positives, particularly in environments characterized by strong directional trends. For instance, if the price reaches the lower Bollinger Band simultaneously with an RSI reading in oversold territory below 30, this alignment substantially bolsters the case for an impending bullish reversal. One of the standout features of Bollinger Bands is their automatic adaptation to shifting volatility levels, rendering them versatile across diverse time frames, from intraday to daily charts, and various asset classes, including stocks like SPY and Forex. Despite their strengths, Bollinger Bands can produce misleading false signals during prolonged strong trends, since they primarily gauge volatility rather than predict directional price movements on their own. To mitigate these risks, it is essential to interpret Bollinger Bands within the broader market context and always seek confirmation from additional technical indicators like RSI or MACD. Mastering the nuances of Bollinger Bands equips traders with a robust framework for dissecting market volatility patterns and anticipating key price movement shifts effectively. When thoughtfully combined with other proven indicators, Bollinger Bands empower traders to navigate and capitalize on the inherent dynamics of volatile financial markets with greater confidence. Thank you for watching our lecture on financial technical analysis, focusing on the Bollinger Bands. See you at the next lecture.